Hello there, and welcome back to my YouTube channel. James here as ever for today's really important financial management. That's the F9 ACCA paper with my top tips with question analysis from a past paper. That's from the March and July 2020, available for you on ACCA's website. And I'm going to walk and talk you through it. That's from head to toe with my insights. It's going to help you with your upcoming financial management examination. What I've done for you is I've put the actual link to access the document we're going to be going through so you can try the question beforehand and then we can walk and talk it through together. That is going to be massive in terms of your actual ACCA exam preparation. For those of you who have not visited my channel before, my name is James. I'm an ACCA qualified member from the UK, and my channel is 100% student-led, set up to help people like yourselves with your upcoming examinations from my experience as a tutor and as a qualified ACCA member now. I am also available on Instagram and you can subscribe. All the details are below, so feel free to hit the button as well so you get updates from all of my social media channels and all of my new videos as well, because I answer every single description, comment left in every single video. And Baron, I know you're out there. You dropped me a message on Instagram as well. Thank you very much. So no, today's video is dedicated to you, but also TS, thank you for commenting on the previous video on my channel. Again, I don't know what TS stands for, but it's a case of Taylor Swift. If that's you, then I hope you enjoyed today's video. I'm sure it'll be delightful. All the other descriptions to this video, the links to the document, other resources for financial management that I would recommend that you buy to pass this are all down there. So feel free to check them out. They're all up to date and they're definitely going to help you in passing this examination as well. So make sure you've had an attempt at the actual question beforehand. You can replay this video, stop and start it, whatever works best for you. So without any further ado, I think we should get stuck into this question. 3, 2, 1, go. Okay, so I'm down at the bottom. This is the document that you need to have up on your computer screen. So this is the financial management sample questions from the March and July 2020, as you can see above me. I've put the link to actually access this in the description to this video. So click the link, it's going to take you straight there. We're going to go through question number 1. It's called Pumice Co. I'm going to go through it head to toe, all the analysis, all of my notes on it. And this is sort of it in terms of it. This is the document that you can have access to on here. So it's got all the sort of introduction screens. And then if you scroll down a bit more, keep going, James. There we go, rock and roll. So there's the Pumice question on here. And as you can see, we've got a bit of information on there. Keep going down. And then we've got a few more details. And I can hear you saying to me now, James, oh my word, there's quite a lot of things on there to analyse. Plus, then you've got to go down. We've got 10 marks here. Okay, so we've got to have a look at some time management. How are we going to lay this out? And then to make things even a bit more overwhelming, you've got the same bits of information again on there with a sort of final requirement at the bottom as well. So plenty of information on here to go through in terms of everything from processing and working capital management. And I can hear you now saying to me, James, how on earth are you going to make this interesting and to go through it so it's going to be easy to digest? A reasonably not too long video, but trust me, watch this all the way to the end and you're going to be so confident, so many notes to go through, because would I let you down? I mean, come on, we've got to start off with, we've got the question analysis on here, but always tip number 1 when you're coming on to any requirement. And I know this is sort of split out because of the workings on here, the way for the computer-based exam where it's pulled from, but it's a case of we're going to go through the question analysis, so get your pen and paper ready. That's going to be really key. But as always, you've got to go to the requirement first of all, and in using the sort of Excel formatting, if you're doing it as a computer-based examination, make sure you're practicing again and again and again. So the first thing to get down is we've got a 6 marker and we've got a 4 marker here. So first of all, get down, it's about just over 10 minutes for part A. That's part I, sorry, on there. And then for the 4 marks, it's about 7.2 minutes. So call it 7 on there. But there are key words, key phrases that we need to pick up on here that are going to save us so much time in our question analysis, and things we need to be picking up on as well in terms of exam technique. So having a look on the first one there, we've got to prepare a forecast statement of financial position. So straight away there, I'm thinking, well, I've already seen one up above when I've just had a flick through straight to the requirement. The key thing there is follow the actual format of what is in the question above. That is going to match the answer because we're going to have a bit of a difference because we're forecasting what's going on into the future. So first key tip there, whether that's statement of financial position, income statement, whatever it may be, use it to your advantage. I'll take you through it when we go through the question above. Now, on to the next bit on there. So we've got a forecast, statement of financial position, Pumico, nice. Calculate the effect of the proposed expansion on the working capital ratios listed by the finance director. So I've put on there simply hints given in the notes above. So it's a case of we've got to find the finance director up above. We've got to actually calculate those working capital ratios. So it's going to tell us up there the ones we need to calculate. And the other thing to note on there is proposed expansion. So it's almost starting to hint you already. There's a before the expansion and after the expansion. And that's likely to go into where the forecast is straight away. And as I put it on there, you can see just above me, we've got practice because of the actual formatting, depending on the sort of style of question that you have. So that's the first one, that's the first 10 marks. And again, because it's a computer-based examination, you've then got it again on here. So we're going to come through this up above. Don't worry. Don't you worry about this. I've analysed it. We've got to go on to the final requirement at the bottom here. So we've got a 5 marker now and a 5 marker. So give or take, it's going to be 9 marks each. And overall for the 20 marks, going on the basis that you have 180 minutes in the examination for 100 marks overall, that's 1.8 minutes per mark. Now I know you have 15 minutes give or take, but this is sort of the benchmark across all my videos and what actual the ACCA also recommend for it, giving yourself that sort of bit of leeway. I do have recommendation videos on different exams, but that's for another day. We've got to focus, eyes on the prize on this one first of all, because this is where the external examiner wrote in their report where students went wrong on this, is because they didn't identify what they were required to talk about. So hence on here, all I'm interested in underlining is the key facts and the key figures. That is it. And I put on the left-hand side for investment policy, funding policy, you must refer to these in your model answer. And whatever it may be in your actual examination, pick up on those buzzwords, those key terms, and actually write it into. So the changes in the investment policy for Pumico would be here. You're already setting up your answer, so you're answering the requirement effectively. Really good exam technique, so you stay on track and you're going to be hitting more of the answer analysis and those marks to pick up. So there's only 5 on this. So discuss the ways in which implementing the proposed changes, okay, so something's going to be changing up above in working capital represents. So working capital, the cash management, trade receivables, trade payables, inventory, and then the knock-on effects on investment policy and funding policy as well. So we've got to be thinking of how much debt we may be taking on, what we're going to be doing with those funds as well, how effective we are. But remember, we've not even looked at the question and analysis yet. And these are the ideas that are going through my head, what I'm going to analyse, what keywords I'm going to be putting into my answer. So that is the first thing to get us going on there. Now, come back up. And again, if you've attempted this beforehand, absolutely epic. But remember, we've got that proposed and forecasted statement of financial position. So I'm just going to roll you through now what I thought when I actually analysed this and what I would be doing if I had to sit the financial management examination. So let me roll it through. We're looking at scenario 1 as well on here. So for the March and June 2020 paper, we've got this scenario relates to the 4 requirements. Lovely stuff. And then Pumico plans to expand its business. Okay, so that was what it was referring to in the requirement below. Its business operations by opening several new outlets. Okay, so automatically I'm thinking, oh, hang on, well, it's not just the odd one, it's actually more wider than that. So there's a bit more risk associated with it at a cost of $8 million. Okay, and notice on the left-hand side, I'm already thinking here, well, this is before the expansion. So this is how the business operates before the expansion. We now know about the outlay of the potential cost as well. And it's going to be financed by the issue of loan notes. So straight away I'm thinking there, well, that's non-current liabilities, and that's going to impact the balance sheet straight away. So if we do go through with the forecast and we propose it, that $8 million's got to be included down there. The company currently generates credit sales of $80.768 million. Okay, so that's sort of revenue in terms of it up at the top. And then we've got before cost of sales of 27.7 million. So I've put that in terms of the pro forma then. Well, can we maybe relate a point back to gross profit? Is there any more information later down below? But these are the things that go through my head as to, well, if I see credit sales or revenue, then I see cost of sales, I'm thinking automatically gross profit in there straight away. Might be relevant, might be not, but this is what I was going through straight away. And also, I'm also thinking, well, proposed changes, maybe that's going to relate into other ratios, how we're going to calculate. So that's why it's really key to get before the expansion noted up here so we keep those figures separate. All sales are on credit, so nothing referring to cash, so accruals basis, so that money will be owing to us from that amount given. And the current statement of financial position, keyword on there, current, if you've got a highlighter in your notes on there as well, because this is before, is as follows. Now, what have we got going down here? And again, I've just put a little side note on there to say before the expansion. Coming on to the workings later on, and it comes up in a lot of queries as well, especially in the external examiner's report, that some students need to refer back to the accounting equation as to, well, why do the assets and the total equity and liabilities balance from this? Well, it's from the accounting equation. And later on, I had to put this in because it relates to, well, why is one going to balance? Because there is going to be a balancing figure in here as well. So these are the sort of things I think of. Plus, automatically, I'd be thinking, well, that loan from up above, that's going to be coming down here in the sort of non-current liabilities. We're going to see a change there. But let's roll it through to the other notes before we get into the answer analysis. So all the important stuff above me. And this is what I was picking up on as I was going through the actual question itself. So Pumice Co expects that the expansion will increase. So now we're talking after the expansion, so after that loan going through, to increase credit sales. So automatically I'm thinking in my workings straight away. 18.7, we're going to have to definitely multiply the revenue up above by that, with cost of sales being 33% of those credit sales. So whatever answer we get, multiply it by 0.33, that's going to give us our credit sales for that. Cool, nice and easy. And profit after tax being 6.818 in terms of it. Okay, lovely stuff. Non-current assets will increase by 11%. Okay, lovely stuff. We've got a non-current assets figure up above. Multiply it by 11%. Big tick, James. Give me half a mark for it. Okay, so that's the first one after the expansion. Key figures, key percentages, these will be straight in my workings before I did any pro forma. Get those marks in the bank. Next thing, the bank itself. The bank has demanded that Pumice Co overdraft to be reduced to $3 million. So straight away, after the expansion, the overdraft figure has to be $3 million in terms of it in your forecasted statement of financial position. Take it easy, go through it, key facts, key figures. The company expects its cash balance to be $700,000 after the expansion. So again, go back to your current assets. In the cash balance, it's got to be $700,000. Pick up that other half mark, get it in there. That's what it has to be as a result. Now, Pumice Co has been receiving complaints. Oh no, why? Why so? From its suppliers about late payments. Okay, so they've had goods off their suppliers. They've taken too long to pay them. Why is this the case? So, I'm thinking, can I make this into a discussion point later on in those requirements as well? And the government plans to improve its the company plans to improve its capital management as part of the expansion. Okay, so when they expand, they're hoping to get these actual days into line a bit more to, build up better relationships with their suppliers. It expects that the following working capital ratios will result. Okay, so these are the answers to the inventory holding period, trade receivables period, trade payables period. And automatically, a well-prepared financial management student will be thinking straight away, I'm going to have to calculate some of these again, potentially. I've already seen revenue. I've already seen cost of sales up above in terms of what they're going to be after the expansion. So read between the lines in what we're going through as well. And I've also noted on there, I've put just under 2 months to pay suppliers. Why have they complained? So in other words, after the expansion, it's going to be just under 2 months. So we're going to have to work out what it was beforehand as well. Why are they complaining? That is another key thing, just reading between the lines. What do the suppliers want from us, and the trade payables as well? Really key on there. And the hints are coming now from the requirement. This is where if you've got really good analysis going through it, as you can see on here, the finance director of Pumisco, and the alarm bell should be ringing right there to say, I've seen that in the requirement below. Because we've gone through it straight away, wishes to investigate how the expansion will change the following ratios. So straight away there, you've got to be thinking, well, the trade payables, the payment period, okay, see above, and the complaint. That's something you could again refer to. We've got the current ratio, so this is coming back to, can you remember them top of your head? The current assets divided by the current liabilities. And then also, we've actually been given on there the revenue divided by the net working capital ratio. So it's given us on there what the ratio they want us to actually work out, defining the net working capital as inventory plus trade receivables less trade payables. So see above, you've been given all that information. I know it's not orthodox, but they've given you the actual layout for it. All you've got to do is follow it through. And again, if you've actually maybe made an incorrect calculation above or something on those lines in your workings, if you follow your own figure all the way through, you will pick up the marks for it as well. You're demonstrating you know the techniques associated with this. And finally at the bottom, not to miss this, but it came up in the external examiner's report that we all know we've got 365 days in the year, apart from a leap year, but they've assumed on here there are 360 days in a year. Would get overlooked, but it's just something there because I've noted it up at the top, trying to reference it with 1, 2, 3. They're all calculated in terms of the number of days. So if you put in 365 or 366, whatever it may be, you'd be actually over or understating the amounts it would refer to. And breathe, James. That is all in the question analysis straight away, and then you go back to your actual requirements, start to bullet point some bits down, go through. I mean, first of all, I'd be thinking going into the answers, you've got to be thinking about the 18.7, but we were actually asked, as we said, about the actual statement of financial position. So we've got to forecast the statement of financial position. We've been given figures that are going to change. So for me personally, it'd be a case of getting down all the workings for all these changing figures. So going through the actual notes that we've been given, line by line, getting down all your workings. And then this is the format. Start from the top, use the dollars, get the correct amounts in terms of the numbers of zeros. So we're not getting that incorrect. Then go work your way down. Assets to current assets, total assets. Then equity, non-current liabilities, current liabilities, and then hopefully it's going to balance as per the accounting equation. So that's just an insight as to see how you did with your answer analysis, what you went through, and we'll start to go through it now as a result. So again, these are the answers that you can have. They're on ACCA's website. These are what I provided for you. I mean, oh, lovely, look at that. And for me, I'd have these workings up at the top, above it to start off with. Keep it simple in terms of it on here, works it all the way through, and I can hear you now through your camera going, good Lord, James, how are we going to go through this in a fun and easy to digest way? Well, this is all of it top to bottom on here, but again, would I let you down? I've done the donkey work for you. Let's start to work it through then on here. So this is my actual answer analysis. And I followed there so that you can make any other small notes, screenshot it, send a photo of this to your study buddy, whatever will work in terms of it. But this is a sort of technique of what I was thinking as we went through it. So I'd actually recommend that you go through the analysis first of all in terms of the workings. So starting down at the bottom here, within the workings, just going through it straight away. And what it's basing on here, I put it down as balance sheet or as an income statement sort of amount. But I'm just simply working it through from what they said in the notes. And then actually, well, it's a case of I'm just going to work it through, get down all my notes, and then head back to that pro forma as well. So quite simply, going through the first one on there, the non-current assets, multiplying it by 11%, that's going to increase it. Remember, anything times by 1 point something is then going to be that 11%. So if it was an increase of 2%, it would then be 1.02. For example, just so you're aware, so we're all crystal clear. The other thing just to note on here, which I think they could have been a bit clearer in terms of their analysis, but just so you're aware, for a bit of insights, look at the non-current liabilities figure up at the top. Non-current assets figure, so 60,018, and look at the answer in the workings. So 60,000 or 60 million, should I say, 0.17700. So just be careful on the units that to round up here. Remain consistent as you go through, because remember we're working in. That's why I said 60,000 018, because we've got the 3 zeros that takes it up to a million in the formatting. So just be aware of it, and so keep on top of it, keep it consistent, and it's going to really help you out with all the workings going through. Revenue on here, so the next one down, we've got the revenue previously, and it was increased by 18.7. The exact same technique here of an increase. So see the notes back in the question analysis if you didn't get that down. But the other key bit here is look how these figures are then used later on. So I put a little star on there that it's then used within the cost of sales workings, the trade receivables workings as well. So it's all pulled through, just so you're aware of it. And you've got my side notes on there. Because remember, and then this would be going through those notes sentence by sentence, working it down and giving yourself line by line. This would be absolutely spot on how I would go about it. It's a case of the revenue multiplied by and the 0.33 for the 33% of revenue after the expansion here. Remember, we're going to forecast this into the statement of financial position. And again, that figure is then going to be used below, because we've got to rearrange some of the actual amounts now, because we're given some amounts, but we need to be working out what is the inventory figure to go into the forecasted statement of financial position, what is the trade receivables, we've got the reserves as well we need to have a look at, and all the others coming down here. So let me scroll it down a touch more so we can see these off. So notice here the cost of sales figure that we had, the 31,637,633 multiplied by, now this is where the 50 came through in the notes, divided by the 360 days. So this is as per the requirement. So those answers on there for the inventory, trade receivables, and also we've got the trade payables at the bottom, all from rearranging the usual ratio. But now we're looking for what is the inventory figure. We were given the number of days, we're given the total number of days for the year as well. We've rearranged that formula now, and so we've got the figure for inventory, we've got the figure for trade receivables. We've then also got the actual reserves on here. So the 34,000 was in terms of base year. Okay, so that was from the previous accounts, plus the 6818 was actually from the profits for the year. I put on there the actual balancing amount just as a sort of side note, because in some questions I've seen in the past, they don't give you the actual all the figures. So the actual reserves are down as a balancing amount there sometimes. But in this question, the 6818, just so we're crystal clear, is the actual amount that you put in. Another half mark hopefully in the bag for that. And then finally, not to overlook, we had a look through it in the actual question analysis, that the non-current liabilities, because remember this is after the expansion, because we're going through with it, this is to make sure you're covering all bases on this. Make sure you're showing all your workings, because you might actually miss this out for the £8 million for the loan to actually go ahead with this as well. I put a final note on the side there for the trade payables, so where the 50, the 60 and the 60 actually came from, they're in the notes, but it's just rearranging that formula because we're looking for the amount that was actually found in the balance sheet. So you can actually work it out, do it the opposite way, and it will tell you how many days as a result. So that actually nicely sort of concludes us on there, but let me take you back up to now the statement of financial position. So if you want to get down in your notes here, really key to get this jotted down there, take the workings, now apply it back to the statement of financial position pro forma. So use the question as an actual pro forma to go through it. So let me take you through it up here. So this is the forecasted for part A, and I've just simply put in the figures. So the 60 million 018 as per the little bits of rounding, tick off. Inventory figure, trade receivables, tick off. Now, other bits in that notes of that paragraph we've got to not overlook now. So the balance expected in the cash was the 700,000. That's what the bank wants in terms of it. Then we go down. We weren't given any indication of any changes in equity. And again, I've highlighted for you the accounting equation, why it would balance on there, totaling it up. So make sure we don't get any transposition errors. Totaling it up, going down. The reserves figure, calculated below, but careful if we need to make it a balancing figure in the future. The non-current liabilities, I made sure I put in another note on the side there So we follow it through as per the loan. And then finally, what the bank expects us to do in terms of the overdraft, it's got to come down from, I think it's 3.5 to 3 million in terms of it. So those are the key figures that can't move as a result. So there you have it. Your total equities and total liabilities are equal to your total assets, all your workings, top to bottom as well, with the references and with the workings. But it's a case of you followed it through just like we've walked and talked it through. There's some easy marks to pick up on there, and the format was already given to you. Now, we were asked as well in terms of the trade payables payment period. So currently, we were actually asked a case of, well, where are we trying to get to? And that was the 60 days. So we're given that. Remember, we've had that actual sort of argument with our suppliers that we were taking too long. But remember, before the expansion, we don't actually know. We weren't given how many days it was referring to. So I'm just going to simply take it as before the expansion, what figures did we have? And these are all from the actual opening paragraph. But the key thing here from the external examiner's report was you still got to apply the 360 days. That is the key thing on there. So simply apply it from the actual trade receivables and the actual cost of sales figures on there. So you'll find that if you pause this video, flick back, have a look. I'm still going to walk and talk you through it. But at the end of the day, the company is targeting 60 days, as we saw from the director in those little notes of 1, 2, and 3. The answer that we currently are working at is, well, the company is operating at 126 days. So think about it there as, I wonder why they are annoyed at us in terms of it. So the target is 60, and we're 66 days off. So think of that from a cash management or a working capital point of view. Very good for us because we're holding on to the cash for longer, but our suppliers are definitely not going to be happy. They're not going to give us any discounts in the future because they want the cash back off us for the goods they provided. So make sure you see note 3 on there. That's where it's just simply referenced from. And again, getting some more lovely marks in the bank. But also state the marker as well, because imagine trying to go from 126 to 60. That is a massive jump in terms of it. So I've just simply put on there, state the marker. It's a case of we're looking to be pretty ambitious on here. It's a massive jump in terms of just after a simple expansion. Usually these things would be sort of more continuous in terms of or sort of gradually improving rather than a massive half it so quickly. Now, what have we actually got in terms of going through this a bit more in detail as a result? So we're actually asked, these are the ratios in terms of what we're asked to calculate here as per, if you want to refer back to, the actual director. So really key on here that have a look back to the question analysis. So this is, remember, before the expansion, the figures from the question requirement on here, and simply taking those current assets divided by the current liabilities, and that gives us a current ratio of, in other words, $1.30 to every $1 of current liabilities on there, a 1.3 to 1 ratio. Whereas after the expansion, it's actually saying here that it becomes, well, we've got 21,073 divided by 8,273. So again, this is really key in terms of your workings, splitting out. What did we have before? What did we have after? So figures basically used from your answer above. If you want to make a little reference on there, where these figures are pulled from, and we're in actually a more positive position. So what does it mean in terms of, I mean, they put down here, it suggests the company is looking to increase its solvency. Yes, or in other words, they're looking to have more cash reserves in terms of it to pay any short-term liabilities. Same way of saying it, I'll still give you the marks for it. You're analysing it's gone from 1.3 to 2.55. But the key technique to get down here on the side is calculation, explain what it means. Calculation, explain what it means. And if you do that for this exam, you are going to be fine. That's it. But again, let's use the hint from the requirement. What did the director want us to calculate? And again, I'll put on the top there the actual workings for it. So we've got the inventory plus the trade receivables less the trade payables. So that was given to us in the question. Use it. I know it's not orthodox, and also referring to the revenue on there. So in order to calculate the net working capital before the expansion, we've got 6.63. And then the net working capital after the expansion, so again, using the figures above, what you've calculated, If you use your own figures, you'll get the own figure marks pulled forward. Analyze these, okay? So those figures there, the 6.63 and the 15.1 that you can see just when my mouse is on there, they are then used further down here. So this is really, you've got to be really careful in terms of your zeros now, because instead of it saying 80,768,000, we've taken off those 3 zeros. So if we're going to take the 3 zeros off the revenue, we've got to take the 3 zeros off the net working capital as well in terms of that. So what are we looking at now? Again, I've put it on the left-hand side there. Keep it simple. Before the expansion, after the expansion. So we've got the revised revenue and also the net working capital, and we've gone from 12.18 to 6.35 in terms of it. So there's a bit of rounding in terms of it on there, but it's just so you get a bit of transparency as to, well, if I was in that situation, if I see 616, it's 6, so round it up, it's above 5. So take it as a rule of thumb that that is what the external examiner is looking for here. And as we go through again, there would be a substantial increase in the capital supporting revenue. So that technique again, calculate, explain, calculate, explain. It's just keeping on going through this question and others that I've seen from the external examiner. And this is where students throw away marks as well. So as I said on here, there would be a substantial increase in the capital supporting revenue. So in other words, better for the business and functioning more efficiently as a result. So utilising what they have in a more better fashion to create more revenue. We've got more current assets or better working capital management and a higher level of revenue on there. So let's roll this down now to part B. So we've got changes in working capital, and I should say for part A as well, if you've got other areas of reasonable points that relate into that, or trying to explain that, revenue's going up or current assets are going up, or it's a reasonable point that is describing what is going on in the business, that would also gain credit. I'm just going through what they've got on here. But don't think if you've got something different, oh, I'm not going to get the marks. If it relates to the point and it backs up the points with your figures, that could be liable to getting halves or 1 marks as a result. So don't overlook that. Make sure you're answering the requirement and say to yourself, am I applying my figures and my knowledge here to the situation, to the scenario? And if you can answer yes to that, then you're going to be more than likely picking up marks as a result, if your answer isn't in this sort of document on here. So now I've got to come on to the changes in working capital investment policy. And as you can see on here, I put, you must relate this in your answer. But I'll just walk and talk you through how they've laid out this in terms of, with a bit of workings, again, workings, state your answer, coming up again. But they sort of just state off, especially in this question, and when we come on to the latter one as well, and in others, it's almost as if you kind of get half a mark for stating the definition, setting the scene to the marker to say, do I actually understand what working capital investment policy is? So what does it consider? It considers the level of current assets used to support revenue generation in relation to different companies, or in this case, one company, because we're only looking at one. But remember, we've also calculated that up above as well. So a company adopts an now. This is where we're going to work it through into more definition, more strategic in our answers to say, we're going to hit the nail on the head in various different areas, and I'm going to force the marker to give me some marks for this as well, because I think it was 5 each for these, so we've got to be really particular as a result. So the company adopts an aggressive working capital investment policy relative to another company if it uses a lower level of current assets to support a similar level of revenue generation. So in other words, they're trying to better allocate their resources. Conversely, the second company adopts a conservative working capital investment policy relative to the first company. So the key words to make sure you highlight or circle in there, we'll see it in later, is conservative and aggressive. That is the key thing there. But in other words, just trying to reduce it down in terms of the working capital management, but at the same time increase the revenue as well. So working on that better allocation, better systems, better processes of the business as well to help it try and expand and to not get into any working capital issues. So while there are no companies here to which to compare, so Perfectly happy to state, as we talked about earlier, we're looking at the earlier year and the current year of Pumi's Co. Working capital investment policy. The effect of implementing the proposed changes in working capital can be measured by revenue divided by the current assets ratio. In other words, we had that up above, but we've actually got, I put it on the note on the side, no real change, even with the revenue going up by 18.7%. So notice that I'm even trying to refer back to the examiner's own words on there. So it may not directly relate to this actual question, but it's a case of I've been given it. I'm going to put it in there as well to say, but if revenue goes up by 18.7%, that is a lot after an expansion. So let's work it through. So this shows there's been no significant change has occurred as a result of implementing the proposed changes in working capital, as this has only changed from 4.7 to 4.55. So this refers to the workings at the bottom, as you can see. So we've got before the expansion and after the expansion. So just simply taking, well, what was the revenue before the expansion, showing that 18.7% increase, and then with the actual current assets and we've got the current assets before the expansion, and after the expansion. So in other words, what we're saying there is, well, after this expansion, it's actually gone down a bit. However, linking back to my point up at the top there, the revenue has increased by 18.7%. So there really hasn't been anything to be shouting about in terms of this after the expansion. What have we got in terms of the next paragraph now? So we've got that the revenue / current assets, so again referring to the key figures at the bottom. So let's have a look at the bit at the bottom. So these are figures that we've already calculated before. So that net working capital, we're referring to previous workings. So this is where if you've got those workings set out up at the top, and just like we went through for part A, you are going to be absolutely set on for this, because literally just referring to the same figures, looking at and comparing, well, what's the revenue like in comparison to the net working capital? And the difference here is comparing, if you look on the side, we've got the revenue and the revised revenue, the same numerator in these figures up here and these figures down here. But, the key thing is we're using current assets as the denominator, or figure on the bottom, versus now we're actually referring to the net working capital. So this is the comparison. We're saying, well, current assets versus the actual net working capital. What are the differences in our analysis here? And this is where we're going into the real technicalities of financial management. But this is how you're going to get the top marks of 4 or 5, well, full marks on this, I would say. So make sure you've got the note down on the left-hand side there for the denominators. And what we're saying here is it appears to be less sensitive measure, that's the revenue to current assets, of working capital investment policy than revenue divided by net working capital, which has changed from 12.18 to 6.35, okay? As a result of the decreased reliance on short-term working capital funding implicit on the proposed changes in working capital. Okay, let's break that down, because that's a very complicated paragraph for something quite easy by highlighting less sensitive measure and decreased reliance on short-term working capital. In essence, what it's referring to there is that what we've got here is we've got less movement in the answers from the changes applied, so better working capital management and more funds are available. What does that mean in simple terms for me anyway? Well, if you look at the bottom of the workings, 4.72 and 4.55 are relatively close together before and after the expansion. Whereas if you look at the net working capital, it goes from 12.18 to 6.35. Hence, that is why they're referring to a less sensitive measure. What they're also referring to here is a decreased reliance upon short-term working capital funding. So again, what are we referring to there? Well, we're going on about, we've got the current assets up at the top, so we've got 17,000, 21,000, but we can still manage at the bottom when we actually have a look at this in a different light. We've gone 6.6, 15.1. So we're better organising our working capital, as we can see from the latter calculation, and by having more funds available to us by organising that in a more effective way. So utilising the trade receivables better, the inventory better, and the trade payables on there. So I'm just referring to the elements in that actual net working capital. That's literally it, because as you can see here, what have we currently got in terms of it? So again, let's keep it simple, relate it to figures. Before the expansion, we had 6.63, and then after it, we've got 15.1. So we've got more funds available that are going to help the business out. Just different ways of saying it. It's just trying to break it down that makes it more easy to digest for you as the viewer, should we say today, and then taking these concepts so that you can now apply it in future questions. That's why I think about it as well. Just see what answers you've got, and then they had sensitivity on there, all these other various bits. So that was actually looking at the investing policy. Now we've got to look at the funding policy on here. So this is part B, part 2. So changes in the working capital funding policy. Again, remember that tactic. First little sentence or so, actually stating to the marker what it actually is, what is your understanding. And this is also a good benchmark. You'll see in terms of the key terms highlighted, 1, 2, and 3, we've already seen this above. So if you haven't got down in your notes, working capital, policies, conservative, matching, aggressive, you've got to get those down in your notes. That is going to help not just in this question, but in various others, because working capital is fundamental in the financial management module. So let me walk and talk you through the working capital policy, stating what the requirement said. Remember, we did that in the requirement. Can be characterized as conservative, matching, or aggressive. Tick, tick, tick. Lovely. You've got the key elements on there. Depending on the extent at which fluctuating current assets, so we've had that in the ratios above, and permanent current assets are financed from a short-term or long-term purposes. So, in other words, those 3 key highlighted terms, notice in the paragraphs below. Paragraph 1, conservative. Paragraph 2, aggressive. Paragraph 3, matching. It's a really good benchmark so that you can now align your answer. But how are the actual current assets financed is going to be key here. So what elements are we referring to? Is it going to be, and this is where if you want to draw a little scale on it, something that's going to help you remind yourself, because in essence, I'm not going to lie to you, it's a case of quite simply short-term funds or long-term funds. And at one end, you're going to be using one, and at one end, you're going to be using the other. But I don't want to spoil your fun, because we're going to walk and talk through the answer so you can check off to see what you got on this. So let's keep it simple. We'll follow the answer as we said on here. So first keyword highlighted was conservative. So a conservative funding policy will use long-term funds. Get that highlighted, get that in your notes, put it on your diagram up above, to finance permanent current assets, so from the balance sheet, and a proportion of fluctuating current assets. Okay, this is a low-risk policy, as long-term funds are less risky than short-term funds from a company perspective. Okay, so straight away, I'd be having down here, well, actually, let's finish a sentence. Don't be rude. But as long-term funds are more expensive than short-term funds, this policy also decreases profitability. Okay, so this is where the note on the right-hand side relates to higher amounts of interest to pay in the long run. But in essence, from that paragraph, if I was you, conservative funding policy, long-term funds, low risk, more expensive, higher amounts of interest. There you go. 5 little points, 5 little triggers that you're going to remember from it. This then should prompt you into, well, what's the other end of the spectrum here? So aggressive funding policy is going to be at the other end. We'll use short-term funds, so you previously had long-term, to finance fluctuating. Again, refer back to it, current assets, permanent current assets. This is a higher risk policy, again, short-term, different policies relating to it. Going to be riskier because going into different markets as such on there than long-term funds from a company's perspective. But, as short-term funds are cheaper, we're not going over such a long period of time, we're not going to have as much interest to pay. This policy also increases profitability. So we've talked about different ends of the scale there, but in essence, it's a case of if you have a shorter term in terms of it, then you're going to have maybe fluctuating and higher levels of interest payments, but you're not going to pay as much in the long run if it's, say, 2 to 3 years versus 30 to 40. So trying to think about it logically as you go through. Now, coming on here, we've got the actual matching funding policy. So this is sort of middle ground, and it's simply referring to applying the actual matching principle. So in essence, it's recognizing the revenues and expenses for the period incurred. So slightly on an accruals basis here. So in the short-term funds to finance fluctuating current assets, and basically in terms of paying it as well. So incurring these in the period, whether that's income or expenses or revenue, shall I say, on there. So this is where we've now covered mainly some of the key bits on here, but now going into a bit more information and depth. So this is where you're going to be pushing for that 4 or 5 out of 5 on this. So while there is insufficient information to determine the relative levels of permanent and fluctuating current assets, so again, it's the same terms referred to again as above. Implementing the proposed changes in working capital shows, and this is the key bit, a substantial movement to using long-term funds. Or in other words, get it from above. It's a case of, well, what have we stated is the policies, okay, and then apply it back to the scenario as to, well, what does that actually refer to? So rather than short-term funds, so what are we looking at here? Go back to before the expansion, 77% of the current assets are financed from short-term funds on here, so that's trade payables and plus the overdraft. Now, just to make this a bit more simple in terms of it, I'm going to take us down to the workings as well, because I can hear you saying, James, where's 77% come from in terms of all of this? So as you can see on here, let me ping on the workings for you. So this isn't your sort of more traditional sort of ratio that you see, but get it down in your notes. It's all part of the analysis, especially from the policies point of view. Again, before the expansion, all we're doing now is we're flipping the current ratio the other way and saying the current liabilities divided by the current assets multiplied by 100 is going to give us what is that balance by how are things financed by short-term funds. And by short-term funds, we're referring to current assets on here. Current liabilities, should I say. Now, don't get these mixed up again. Remember, we're going to have before the expansion and after the expansion. So current liabilities divided by the current assets gives us 77% before the expansion, okay? Whereas it's only 39% afterwards. So that is the shift between one to another. We've also got the decrease in short-term funds. They, again, referring to the current liabilities, it's gone down by 4.9 million in terms of it. We've also had an increase in the current assets, so again, before minus the after, and this is referring to the figures above that we've got on here. We've also got an increase in the long-term funds, so I've got it down there for you, the equity plus the non-current liabilities, and again, quite simply, keep it simple. What happened after, what happened before? So you can actually use and apply these figures in your narrative, and again, you might have got different figures mixed up, but the key thing on here is if you apply those figures correctly in your narrative, explain it to the marker, you'd be on the money to get some marks here. So referring back to that 77% now, so before the expansion, 77% of current assets are financed by short-term funds, so that's the current liabilities as we looked at, trade payables plus the overdraft. After the expansion, however, so again, answers from Part A, only 39% of the current assets would be financed from short-term funds and 61% would be financed from long-term funds, okay? So what does this mean? This change is also apparent from the increase in the actual current ratio from, again, referring to our calculations from earlier on, 1.3 to 2.55. Use your answers, use your own figures, and apply your workings from before as well. So what does the next bit mean on here? Well, simply saying, well, we're going to apply the theory to the scenario and the figures. So in other words, what's happening in this example to what was stated above? So the proposed changes in working capital therefore suggest a movement by PUMISCO from an aggressive working capital funding policy to a conservative one of capital funding policy. So in other words, quite simply, from a short-term perspective now to a long-term perspective. We've worked it out already up above. We've actually stated what it actually means. So now we can go down to, well, this view is also evidenced by, so again, referring to other funds that we're actually looking at, what other figures can we back this up by? Evidenced by the 4.917 decrease in short-term funds relative to the 3.953 increase in the current assets and the 14.818 increase in long-term funds. So the main key sentence right at the end, remember anything underlined in red is the key things to get jotted down, It's the company's current reliance on short-term funds has been reversed. As we said, it's gone from short-term to long-term. Lovely stuff, nice and easy. And then just to reiterate at the bottom, so you can actually get those down, especially in the last paragraph there, you're thinking maybe, well, where did this 4.917 come from? Well, that's just the decrease in the short-term funds, the current liabilities, as we said, and then also referring to the 14.818, that's the increase in now long-term funds. So that's actually from the increase of the actual loan, and then saying, well, what did we have before and what did we have after? Nice and easy. So when you see it going from the 80 million to the 26, well, after that's going to have the 8 million loan as a result. But what we're getting at here is applying the actual figures to the scenario, use it in your narrative in the answers above, make your answers more robust, and as you can see here, you can see the breakdown of the workings, trying to walk and talk you through it from an easy perspective, take these techniques and apply it to future questions as well. And relax. Well, if you ask me, that is how you go through a financial management F9 paper, top to bottom, answer, question, requirement. How about that? Well, before we leave the video, let's head back to the main screen and we'll crack on with any other final tips on here as well. So 3 and 2 and 1. Well, Varun, TS, Taylor, what do we think after that? That, in my eyes, is how you should be analysing a financial management and F9 ACCA exam past paper from head to toe, with insights, with analysis, and with, as ever, some top tips that are going to help you pass your upcoming ACCA examination. Well, if you have enjoyed today's video, feel free to give it a massive thumbs up below so that more ACCA students will see this video. If you've got any comments, queries, whatever it may be, feel free to put it in the description below with any other videos you would like me to cover. And as ever, feel free to subscribe. The button will also be down there so you get access to all of my free materials. That include the podcast, insights, whatever it may be, all to help you out, as you know, because it's 100% student-led, so I can pass over my insights on there. The final thing is, I can just wish you best of luck with your upcoming examination. I'm sure you've got plenty of revision to go back to now. More past papers, there's more videos on the channel. Go check them out. But as always on that bombshell, I'll see you next time. Cheers!